Lightwave Logic is trading at $6.19 right now. That is down roughly 67% from its 52-week high, but they are hurtling toward a massive make-or-break commercial production catalyst.
Yeah, it is one of the most fascinating disconnects in the market. I mean, you have an industry pouring hundreds and billions into AI infrastructure, and this microscopic company is claiming they hold the absolute linchpin to make it all work.
Right. Welcome to Market Pulse Daily, everyone. Today we are doing a deep dive into Lightwave Logic to decode this wild setup.
It really is a paradox we need to unpack.
Exactly. And real quick before we jump into the Catalyst stack, check the description for a 14-day trial link to StockOracle. Just a quick affiliate disclosure, we are affiliates, so we might earn a commission if you use the link.
And remember, AI insights and value estimates can be wrong. Market data can be delayed, so, do your own research.
Yeah, no financial advice or buy-sell ratings here at all. We're just looking at the facts.
Right, just the data. So let's talk about what actually changed here.
Okay, so let's start with the financials because they are jarring. This company, attempting to save the trillion-dollar AI data center boom, made exactly $61,918 in revenue last half.
Yeah, H1 2026 revenue of basically 62 grand.
I mean, their Q2 standalone revenue was just $32,000. I've seen local coffee shops do more volume than that.
Oh, absolutely. But to understand why this matters and why the market even cares, you have to look past those numbers for a second and look at the physical bottleneck in the AI boom.
Right, the hardware layer.
Exactly. We're asking data centers to process just unimaginable amounts of data for these large language models. The GPUs are incredibly fast, but they have to talk to each other to share the workload.
And if you've ever, sat there staring at a blinking cursor while ChatGPT or whatever struggles to load, you've felt that bottleneck.
Yeah, that lag isn't always the software. A lot of times it's the literal physical infrastructure struggling to shuttle mountains of data back and forth. And they communicate using light, right? Optical interconnects.
Okay, so this is where Lightwave Logic's catalyst comes in.
Exactly. To transmit data, you use a modulator to basically chop up a continuous beam of laser light into ones and zeros, billions of times a second.
But the legacy materials we use for this, things like lithium niobate or standard silicon, they're hitting a physical wall. They require massive voltage swings to chop the light fast enough for next-gen AI.
And high voltage means high power consumption, which means heat.
And heat is the absolute enemy of a data center.
Right. It requires huge cooling systems, drives up power bills, and literally limits how many servers you can physically cram into a rack.
So Lightwave Logic is attempting to bypass this entire structural problem. They have these proprietary electro-optic polymers designed for next-generation silicon photonics.
Basically engineered plastics.
Yeah, instead of brute forcing light with high voltage, they apply a tiny electrical voltage to these polymers, and it instantly changes their refractive index.
It's chemically altering how the light travels.
Right. It's like, okay, traditional modulators are like a heavy mechanical drawbridge. It takes tons of energy and time to physically lift it up and down to stop traffic.
I love that analogy.
But these polymers are basically like installing a fiber optic traffic light. It changes states instantly at the chemical level, controlling data flow with almost zero energy and zero friction.
That is the perfect way to visualize it. And if we connect this to the business impact, you can see why the theoretical upside here is just insane.
Because tech giants are spending billions trying to secure enough power just to keep their data centers running.
Exactly. If these polymers work at scale, they solve one of the most expensive problems in the entire AI build-out: higher speeds, way lower power.
But here is the massive open question, right? If this traffic light is genuinely a physics-defying breakthrough, why is the stock chart such a disaster?
The market reaction has been brutal.
Yeah, like we said, $6.19, down 67% from its high of $18.70. It did bounce a bit from its low of $1.99, but it's trading below the 20, 50, and 200-day moving averages.
It is the ultimate tension between a visionary story and a cold, hard spreadsheet. The market had priced in a future that just hasn't arrived.
I mean, before this 67% drop, they were trading at a price-to-sales multiple of 4,620.
Based on trailing metrics, over 4,000 times sales.
That is just, a healthy hyper-growth tech stock might trade at 10 or 20 times sales. 4,000 means the market was pricing in guaranteed massive revenues that just do not exist yet.
And when reality bites, that multiple compression is unforgiving. There is a Seeking Alpha sentiment report from late July 2026 titled back to earth, but it is still too risky for me.
That pretty much nails the institutional mood right now.
Totally. Analysts see this massive valuation against minimal sales, and they realize the execution risk is just too high at elevated levels. They love the polymer traffic light idea, but they aren't paying for it until it's actually installed and working in the intersection.
And there's another thing I noticed in the SEC filings that adds to that cautious sentiment. When a stock drops this much, you usually look for insiders buying the dip on the open market, right?
It's a classic confidence signal,
But there are 0 open market purchases by insiders recently.
which is a huge tell.
Yeah, you see standard stock grants and 1 open market sale of 345 shares. But nobody inside the company is backing up the truck to buy at $6.
Right, which subtly tells the market that even the scientists who know the lab results aren't betting their own cash at this level.
So we have virtually no revenue, a crashed stock, and no insider buying. How does this company actually survive to manufacture this stuff?
That leads directly to their primary catalyst stack and their survival strategy. They have embraced a fabless model.
Because building a state-of-the-art semiconductor fab costs, what, $10 to $20 billion?
Easily. Lightwave Logic obviously can't afford that.
Yeah.
So they secured partnerships with 3 major established foundries: Tower Semiconductor, Global Foundries, and Silterra.
Okay, so it's like inventing a revolutionary car engine in your garage. But instead of building a billion-dollar car factory, you convince Ford and Toyota to put your engine on their existing assembly lines.
Exactly. It drastically de-risks the manufacturing path. And by having 3 separate partners, they mitigate single supplier risk. If one foundry have a delay, they have 2 backups.
And management has a very specific timeline for this. They are targeting high-volume commercial production by the second half of 2027.
That is the promised land.
But you can't just make the polymers, someone has to buy them. The filings keep mentioning these stage 3 customers evaluating the tech.
Right, and in the semiconductor world, stage 3 is not just a casual trial.
I was going to say, semiconductor sales cycles are brutal. Stage 3 sounds like they're putting the material through absolute hell in pre-production to see if it breaks.
Your read is dead on. Early engagement is just curiosity. But stage 3 is a critical leading indicator of future revenue. It means rigorous technical qualification in real-world data center conditions.
So converting a stage 3 customer into a named supply agreement is basically the holy grail here.
It's the biggest validation event they could achieve. It completely changes the narrative.
But let's look at the bullish path versus the risk, because there is a very loud clock ticking in the background of all these filings, their cash position.
Yeah, the math is pretty unforgiving right now.
As of June 30th, 2026, they have $47.2 million in cash.
And their operating cash flow for the first half was roughly negative $9.8 million, plus about $1.5 million in capital expenditures.
So they're burning roughly $10 to $11 million every 6 months.
Right.
If you do the math, that $47 million gives them a runway of maybe 18 to 24 months.
And look at where that window lands. It intersects perfectly and dangerously with their H2 2027 commercial production target.
Oh, wow. Yeah, so capital adequacy and commercialization have to happen at the exact same time. It's a completely binary outcome.
It really is.
So let's lay out the blue sky scenario first. And just to be clear for the listeners, this is an optimistic scenario we are mapping out, not a prediction.
Right. So in a blue sky scenario, they execute flawlessly. Foundries qualify the process, stage 3 customers sign contracts, and they hit scale in H2 2027, right before the cash runs out.
If that happens, what does the financial impact look like?
Well, this company transitions rapidly into a highly profitable licensing and supply business. Their trailing 12-month gross margin is currently reported at 97.13%.
Wait, 97% margin on a physical hardware product? That's unheard of.
I mean, yes, it's based on their current tiny revenue, and it will fluctuate as they pay foundry fees, but the chemistry suggests that whatever revenue they generate will carry massive incremental margins.
So it operates more like a high-margin software business once R&D is paid for.
Exactly. Yeah. Almost every new dollar of revenue could flow straight to the bottom line.
Yeah.
That would justify an entirely new growth-based valuation framework.
But we have to pivot to the risk side. What are the thesis breakers? Because with a strict 18-month runway, there is 0 room for error.
The main thesis breaker is timeline slippage. Delays in the semiconductor industry are practically guaranteed. Process qualification takes forever.
So if H2 2027 slips into 2028, the cash runs out. And then they have to raise capital at currently depressed stock prices.
Which would trigger a massive dilution spiral.
Yeah.
Selling millions of shares at $6 just to keep the lights on is devastating compared to raising money when the stock was at $18.
And there's also the lab versus fab risk.
Oh, absolutely.
Yeah.
That is the fundamental technical risk. These polymers might look great on a test bench, but high-volume semiconductor manufacturing is a brutal environment.
Right, baking silicon wafers at hundreds of degrees, plasma gases, extreme chemical etching.
Can this organic plastic material survive standard foundry processes without degrading and yield reliable results across thousands of wafers?
If it fails process qualification at Tower or Global Foundries, the entire commercial thesis breaks instantly.
Yes, it doesn't matter how many stage 3 customers want it if you physically cannot manufacture it at scale.
Okay, so synthesizing all of this, the extreme volatility, the cash clock, the foundry strategy, what are the 3 things investors should watch next?
Okay, first, the next event to watch is any upcoming earnings report, like their Q3 2026 update. You aren't looking at revenue. You're listening to management's tone regarding the H2 2027 target. Are they keeping it firm, or are they softening the language?
Right. Second, what is the confirmation signal?
The confirmation signal is a public announcement of foundry process qualification or a named customer production agreement.
Basically, Tower or Silterra putting out a press release saying, yes, this material survives our thermal budgets and scales.
Or a major data center player officially purchasing the material. Until one of those happens, the stock is just a highly volatile proxy for AI hardware sentiment.
And third, the main risk signal.
The main risk signal is the cash burn rate and any hints of a highly dilutive secondary offering. If that runway shrinks faster than expected, watch out.
It is truly a binary race, commercial viability on one track and a burning cash runway on the other. Whichever reaches the finish line first dictates the future of the company.
Textbook high-stakes technology investing.
All right, I want to leave everyone with a final provocative thought. We spend so much time obsessing over which mega-cap company has the smartest AI models or who is building the biggest concrete data centers. But what if the ultimate winner of the AI revolution, the tech that lets this scale globally without melting the power grid, is actually determined by the obscure microscopic chemistry of how light moves through plastic polymers?
The physical world always bats last.
It really does. Keep questioning the world around you, keep looking past the headlines, and check out that StockOracle trial link in the description. We will catch you on the next deep dive.